So every year I watch just normal people, but mostly business owners and real estate investors make the exact same mistake. They wait until the tax season to think about taxes. But by then, it's just too late. So it might surprise you that I literally have tax meetings every single month. Now, the sit-down meetings, I only do 2 or 3 a year. It's literally in my schedule each and every month because I'm always taking a look at what does the tax law say, how can I take advantage of it, and how do I reduce my taxable income? And you should be too, because taxes are the number one expense of your life. So the truth is these strategies can actually save you real money, but you have to have them done by December 31st. They have to be done in the calendar year of your taxes. Here's 4 of the best strategies that you can use right now. The first thing is, especially if you own a business, that you could prepay your expenses to accelerate your deductions. Now, what is this? This is basically pulling forward deductible expenses into the current tax year, even if you won't use the product or service until next year. So let me give you a couple examples. This is really, really good for business owners, entrepreneurs, self-employed professionals. Yeah, so let me give you an example. You can prepay for annual subscriptions. So think of, some kind of trade, like for example, we're National Multi-Housing Council or National Apartment Association or CoStar or any of these big things, even Yardi, our accounting software. You can prepay those things for next year. So think of Zoom, software, coaching programs, all of these things you can prepay. You can prepay rent or lease payments as well. Equipment, maintenance, consulting costs, marketing campaigns that you're going to run in Q1 or possibly even Q2, like to a PR agency. Think of things like employee training and attorneys and insurance payments, and especially travel. If most of us know where we're going to go next year, but even if you don't, you can book some of these conferences and some of these things you can sign up for now and get your plane tickets and all that kind of stuff. This is just a way to be able to prepay expenses in the current tax year for things that you're going to use next year. It doesn't really matter. You don't have to wait until next year. But this, I know from personal experience, this could be hundreds of thousands of dollars that you can take from one year and pay in the current year. You just prepay it. And what you're trying to do is you're trying to reduce your taxable income because there's still expenses. It doesn't matter what side of the line they fall on, if it's January 1st or December 31st. So basically, the government is telling you, spend money on your business, grow the economy, and we'll foot part of the bill. So why wouldn't you take advantage of this deal? So every dollar you prepay is $1 off your taxable income. So let's say you're in a 40% tax bracket. You're basically saving 40 cents on every dollar immediately. So number 2 is bonus depreciation. And this, of course, came back during the big, beautiful bill. But this is a time where you can write off equipment, vehicles. For us, we're doing our billboards. I talked to you guys about this. We're literally buying billboards and writing off almost 100% of the full cost of that billboard. We still own it, but we get almost the full cost of our investment, plus it cash flows like crazy, and we get to write it off in the current calendar year. So what is it? So this is the ability to deduct the full cost of qualifying assets. You got to make sure they're qualifying, like equipment, computers, and of course, certain vehicles. You have to do it in the year you place them in service rather than depreciating them over time. So let me give you an example. So I'm buying some billboards right now in Las Vegas, and I'm going to convert them into digital. So I'm actually buying 6 billboards right now from Mesquite all the way down to Las Vegas, but it won't be till next year that I convert them to digital. So I can write off the full amount of what I purchased this year, but then I can also write off the conversion amount next year. So it has to be in service in the year that you actually do it. So let me give you some other eligible assets. So vehicles over 6,000 pounds, like think of G-Wagons, Escalades, it has to be under 14,000 pounds. Computers, office furniture, tools, equipment for your business. I know a lot of friends that actually go out and buy a bunch of vehicles and they can even finance them for the next year. So they go in and get it. You see the fleet managers at some of these auto dealerships, think of that. They go in and they buy these trucks and these things that they need to run their businesses for the following year. And of course, real estate improvement, like the billboards that we're currently buying. But here's the real wealth strategy. What you don't want to do is you don't want to just buy something for the deduction. You want to buy something for your business actually needs. But if you're going to make a purchase, you got to do it before December 31st, not January 1st. So in the case of the billboards, Ross and I have been exiting some of our apartment holdings that we've had for 10, 15 plus years. And so we have a taxable issue. So that's why we started the billboard business, to offset the taxable income that we're getting from our apartment deals. So that is the purpose. The purpose started because of the tax advantage, and then we worked it into our deal, because all we're trying to do, just like you, is just keep as much money legally that we can by using the tax law. So obviously another powerful year-end strategy is the 1031 exchange. So this, of course, lets you defer taxes when you sell real estate, and then you could roll the gains into another property. So if you want to understand how exactly that works and how investors use it to grow their portfolios tax efficiently, I put together a free guide that breaks it all down in plain English. And you can grab it here. Just click on the link below. So number 3, income shifting. Now think of family and bracket. So what is this? This is legally shifting income from your high tax bracket to a lower tax bracket. That's it. So for example, I have 2 kids. They're in lower tax brackets than me. This is what I'm talking about here. So it's usually your kids or your parents, like my mom, even your own business entities. For example, you can pay your kids under the age of 18 up to $14,600 a year, completely tax-free. Now, this is a standard deduction, no payroll tax if it's a sole proprietorship or an LLC. Now, this has to be for legitimate work, social media, packaging, so you have to make sure that's all tied up with a bow, and it must be documented. You need to treat it like it's real employment. And you can also pay your parents. So you can put them on your board, an advisory board or advisory group, or even admin work. This is a great take care of the family plan while shifting the income to a lower bracket. There's also an annual gift tax exemption up to $19,000 that I've been doing each and every year. You can actually write checks for a one-time annual gift tax exemption that you get each and every year. And I've been doing this for years as well. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. And the fourth one, of course, is cost segregation. I call this real estate secret weapon. So this gets talked on a lot. First, let me tell you what it is. It's accelerating depreciation by breaking a property up into faster depreciating components. So think of carpets, cabinets, appliances, landscaping, those kinds of things. So the result, of course, is massive upfront deductions. And this is especially powerful when you buy or renovate a property. We were doing this through all the value add years. At one time, Ross and I had $68 million of renovations going at one time when we were doing value adds like crazy, just like everyone else. And all of this was also being taken care of through a cost segregation strategy. So here are the real numbers. Let's say you buy an apartment building for $1 million. First, you got to deduct the land. Let's say that's 200 grand. So now you got 800 grand sitting here. The IRS allows you a 27.5 year standard depreciation tax deduction. So that's about 29 grand a year that you get automatically. But what you really want to do is you want to take a look at the components of that $800,000, which is usually around 20 or 30%. Now, again, back to the things like carpet, cabinets, appliances, landscape, those kinds of things you can accelerate into the first year and, of course, spread out over a shorter period of time. So let's just use the 25% figure. So 25% of $800,000 is $200,000. So the bonus depreciation for a short line depreciation is about 60% of that. So you could take 60% of the $200,000, which is $120,000, plus the standard deduction for regular depreciation, and you're at $150,000 to $200,000 in that first year So what you're really looking to do, guys, is you're looking to accelerate as much depreciation you can in a deal that you're going to own over a period of time in that first year. And whether it's just you investing or all your investors, everyone gets to benefit equally from that deduction. So as you venture into this real estate investing world, you also need to be thinking about the tax strategies, because this is a great way to also raise capital, because there's a lot of people out there that are high wage earners that can utilize the tax benefits from these kinds of investments. But it's really, really important that you schedule your tax planning well in advance before the end of the year. In fact, I would just say this week. You need to gather all this stuff together, because some of these things that I mentioned, like these cost segregation studies, they take time to do. We actually have a CPA do ours, and then it's a full report that we use, because the IRS, if you ever get audited, is going to want to see all the backup. So if you guys want to see a deal that we bought recently that we are doing some of these tax strategies on, just watch this video next.